70% returns in 6 months. What should you do with this company? Welcome to KYC. I'm Hiral Dadia, and with me is Varsha Chandani. This company has actually given 900% returns over the last 5 years. Is there more steam left? Yes, we're talking about Sanghvi Movers, and that's the company on KYC's radar. Let's quickly understand what this company actually does, and before that, we'll take you through the key questions that we need to ask the management from here on. First up, Wind EPC as a business is something which is growing. Now, what is the expected contribution from this business versus the existing crane business? Because Wind EPC is absolutely a new entry in Sanghvi Movers' business profile. Moving on. On number 2, you're talking about what will the margins look like? Because the moment a company enters into a new business, there is some bit of pressure that does come in. But on a blended basis, what's that trajectory looking like over the next 3 years, Varsha?
Yep, and we would also want to know the order inflows that is expected for the year. We do have the current order book which stands at around 700 odd crores, but we would want to know what is the inflows expected for next few years. Also, company is expanding aggressively when it comes to Saudi Arabia. We would want to know what is the strategy out there, because they want to become a one of the top 5 players in Saudi Arabia by 2030. And we would also want to know the capex plan for Saudi Arabia and for India. So overall, what is the capex plan for the company in Saudi Arabia, considering the aggressively how company is expanding? So these are my key questions that I would want to know.
So lots to know from the company who's already given returns of nearly over 70% in the last 6 months. Is there more steam left or not? But first up, about the company, clearly, as we mentioned, it's a company which rents cranes, heavy lift services across industries. Now, the question over here, and the reason why we're speaking to them, is because they've expanded into wind energy EPC business via turnkey solutions, and they're offering projects for heavy lifts and infrastructure projects. Now, when you talk about wind EPC expansion, that is the critical part, because the subsidiary also secured a little over 400 crores of wind order from IPPs, and they're also venturing, as Varsha mentioned, into the Middle East market for the wind business. Now, this contributes nearly 34% of the revenues, and this has just jumped in a year and a half. Initially, when they started off, it was nearly 4%. So is there further steam where probably it could become 50-50 between wind and the crane businesses as well?
Continuing with the segment mix, if I were to talk about the crane business, contributes almost 63%. Well, a year and a half before, the company was wholly a crane business, but now, as Hiral mentioned, that they are venturing into wind EPC, or they have already ventured. So 34% of business comes from wind EPC, and 2.4% from project EPC. I would also want to highlight how their order book is looking like. So total order book as of June 2025 stand at around 767 crore, out of which they've already done revenue or already booked revenue for rupees 273 crores. So the unexecuted order book stands at around 494 crore. We would want to know, out of this 494 crore, how much is that EPC segment order book that the company has? And overall, if you see, so a good order book at 797 crore.
Yeah, and I think we were just discussing before the show that 1,000 crores is what they are aiming for now. How true that number is going to be or not, because it was one of the con calls where this number was discussed as well. But moving on, if you talk about their capex plans, 321 crores is what they've planned, and 114 odd crores is what they've incurred in the first quarter of FY26, as you can see on your screens. They've said the capex will be funded through a combination of internal accruals as well as a long-term debt. And why the debt portion is important is because their debt to equity ratio is also pretty favorable. So that is one of the positives that we will be talking about from here on.
Also, I want to highlight that moving on, when we'll be speaking about income statement or financials, this is a key question that we need to answer for, because if you see the EBITDA margin, there have been pressure in EBITDA margin when it comes to FY25 and Q1 FY26. Why? Because of companies venture into wind EPC, which is a lower margin business but high volume business. So if you see the crane business, the margin is almost 56%, but for the wind EPC and project EPC, the margins are lower at at 11 to 13%. So one of the reasons why Sanghvi Movers have seen that pressure in margin because of the increase, or rather because of venturing into EPC, wind EPC.
Okay, so those are the key factors with regards to where about the company goes. But let me quickly take you through the rating parameters from here on. We're talking about the income statement, balance sheet, cash flow, return ratios as always, shareholding, street credentials, the valuation picture and outlook. These are a few of the things that we will consider. But Varsha, you're pointing out something when it comes to the income statement as well, specifically with regards to margins. What is it indicating so far?
Yeah, so as you see the income statement for this company, it is good. I mean, if you see the last 3 years CAGR revenue has been 30%, 3-year EBITDA has been 28%, net profit has been 76%. This would have been more if company wouldn't have ventured into EPC, but because of the entrance into wind EPC has a lower margin, like 11 to 13%, while the crane business has a higher margin. So that's one of the reasons. If you see prior, 2023, from 2023, the EBITDA margins were higher. See, in FY24, the margins were at 63%. Why? Because company was into crane business. But fast forward, if you see FY24 and FY25, the margins were lower because of the entrance into wind EPC, which is a lower margin business. Even in Q1 FY26 also, if you see, the margins are lower. Over the margin trajectory, if I were to talk about, in FY22, company had 47% of margin. Fast forward to FY24 at 63% because of that crane business. But if you see in Q1 FY26, the margins are 38%. Now, this is a new normal margin for the business going forward. So you won't see 63% of margin of Sanghvi Movers because of the business shift that the company has seen. So overall, we have given this a thumbs up because this is the new normal numbers that you would be seeing in Sanghvi Movers going ahead.
Okay, so that's with regards to your income statement, but let's look at the balance sheet. The debt has seen a notable increase, but that's particularly happened between FY23 to FY24, and this is suggesting increased borrowing for expansion or operations. But if you take the debt to equity into consideration, and if you have that matrix here, the ratio remains relatively low, which is indicating a healthy equity-heavy capital structure. And the increase that we saw in FY24 reflects the rise in total debt. So in summary, the balance sheet over the last 3 years reflects a fundamentally sound company with a strong equity base and healthy liquidity. And the moderate increase that has happened in the debt is likely driven by expansion activities, which should be assessed against the company's corresponding revenue and profit growth that Varsha just took us through. And this will actually determine if the deployment of the capital has been efficient, and hence a thumbs up coming in on the balance sheet.
Talking about cash flow statement, let's see how that is shaping up. So if you see in FY23, the cash flow from operations was at 257 crore, fast forward to 24, 304 crore. But in FY25, the cash flow from operation has reduced drastically. Why? Because of, again, the change in business mix towards low margin, longer cycle segment. Now, if you see that one of the main reasons why you're seeing a depressed cash flow from operations in FY25 is because of high receivables. So the receivables jumped from 118 crore to 166 crore. And the negative net cash flow that you're seeing, that is 35 crore, is because of low CFO, that is low operation from cash flow, and also company did some investment, or company is investing, and one of the reasons why you're seeing that negative 35 crore. So overall, because of the higher receivable cycles or because of the higher debtors on the cash flow statement is one of the reasons why you're seeing that depressed cash flow from operation when it comes to FY25.
Okay, let's quickly look at the return ratios as well. Now, while the EBIT has grown, if you talk about the capital employed, that has actually surged faster, and mainly due to the capex and the working capital strain. And this is what has actually diluted the return on capital employed, because if you see the downtake from a 21% in FY24, it's actually come down to nearly 13% in FY25. Now, the heavy capital expenditure that they've done is for fleet expansion, and this has been funded partly by internal accruals and the debt. Secondly, if you talk about the business shift that has happened to EPC, that's the wind business, the lower profitability per rupee of capital in EPC versus the rentals that they get directly has pressured the return on capital employed, and hence that 13% number there, and hence a neutral rating on that one.
Talking about the shareholding, not a dramatic thing over here. We have given a neutral rating. The good thing is the promoter share has not decreased, is at 47.25%. Well, FII's stake has been stable at 1.4%. Same goes with DIIs and same goes with public. So nothing a dramatic change when it comes to shareholding pattern, and one of the reasons why we have given a neutral rating to this.
Okay. Let's quickly look at the street credentials from here on. Overall, if you talk about the performance, 24% up over the last 1 month. 6 months, as I mentioned earlier, 72%. What is interesting is 5 years is nearly 950% on this one. It's just your YTD and 1 year is subdued slightly at 12 to 32%. Though good return so far, no investor has made a loss, and hence a thumbs up.
Well, talking about the valuations over here, now there was a time when Sanghvi Movers used to enjoy a PE of 45, 50, but then it was a crane company. Now the valuations are, if you see the TTMP stand at around 21x, because now this company will get the valuation of Wind EPC business only. The 3-year average of this company is around 22x. So valuations are not that overvalued and not that undervalued. So overall, a fair valuation, I would say, at 21x PE. But do remember that I don't think so that company would get 50, 55, 60 PE, because the Wind EPC, because of the shift in the Wind EPC business, so it will get the valuation of Wind EPC players like. So overall, a fair valuation, and hence a neutral rating for valuations.
Okay, moving on. Let's quickly look at what the outlook is looking like now. Clearly, what the management has indicated is that the expansion, what they're looking at, is mainly in the Wind EPC business. Secondly, their debt to equity will remain lower at 0.35 times, which is a positive. The growth will be on the back of the opportunities that they're exploring in Saudi Arabia as well. And their vision is to be within the top 5 crane companies in Saudi by 2030, and this is rental companies. Very lastly, they have an ambitious revenue target as well that Varsha and I were discussing, but they've indicated around 1,000 crores for FY26 in one of the conference calls, and this will be backed by a robust order book, and the management is expecting to surpass its initial revenue growth target of 30%. We will reconfirm this with them as well, but very quickly, let me take you through the final ratings. A thumbs up on the income statement, a thumbs up in terms of the balance sheet as well, if we can have that one on the screens. Neutral on cash flow and return ratios. And if you see the other ones where you have, almost 1 thumbs up and 3 neutrals, which takes you to a total rating. Let's get that one, 5.518, which is also a pretty strong rating from NDTV Profit. In fact, Varsha also spoke to the management, that is Rishi Sanghvi, MD of Sanghvi Movers. Let's listen into that conversation.
Since Sanghvi Movers is moving towards Wind EPC business, I just wanted to know what is the expected contribution from Wind EPC versus crane business in next, say, 2 years.
Thanks, Varsha, and it's always a pleasure to be on your show. So, at the start of the financial year, we gave a guidance that our core crane rental business would grow between 10 to 15%, and the overall revenue would grow between 25 to 30%. As of today, we have already secured an order book which is 1,000 crores, above 1,000 crores, and this entire order book is deliverable in the current financial year, FY25-26. So we expect our overall revenue to grow anywhere between 10 to 15% every year going forward in the core crane rental business, and a healthy growth on the EPC side between 15 to 20%.
Understood. Also, Rishi, now considering the Wind EPC having a lower margin, what is the blended margin which you are expecting in next 3 years as you ramp up your Wind EPC business?
So, in the core crane rental business, we still expect to maintain an EBITDA margin between 55 to 60%. We are also investing heavily in our rental business, not only in India, but also in Saudi Arabia. And in the EPC business, as it scales up, we expect margins to normalize at around 10%.
And so, understood, Rishi, that. But overall, on a consolidated level, what kind of margins are you expecting, say, for FY26 and maybe for next 2 years as your EPC will ramp up?
Sorry, Varsha, I wouldn't be able to give you that sort of level of detailing. But we are very confident in delivering business unit-wise margins, as I had just previously alluded to.
Understood. And Rishi, as of today, I heard you saying that the order book stands at around 1,000 crores. If you could, give us a split, how much of your order book is from Wind EPC and how much is it from your crane business? If you could, give us a number.
So Varsha, as we have guided, we believe that our top line from the crane rental business would grow sequentially between 10 to 15%. It looks like more than 15%. And our revenue from the EPC segment will more than double this financial year as compared to last year.
Understood. Also, Rishi, if you could, give us a order inflows which you are expecting for rest of the year. Any orders are in pipeline or any talks that you're going through. So, just having a ballpark view on the number of order inflows that you're expecting for rest of FY26.
So, our sales cycle is a long lead sales cycle. So a majority of our order book for this financial year has already been secured. We are positive to get extensions and a further contribution of additional orders in the third and fourth quarter of this financial year. We, on the EPC side, these are long duration projects. So we continue to secure additional orders that may be deliverable not only in this year, but spill over into the next financial year.
Rishi, now let's talk about your Saudi Arabia business, wherein you're investing fairly aggressively in Saudi Arabia. Just wanted to know what's the strategy there, number one, and is investment that you're doing are backed by orders?
So Varsha, we are very excited for the growth story in Saudi Arabia. Saudi Arabia has become the world's construction backyard, and there are a number of global commitments such as the FIFA World Cup 2030, the Asian Games, the World Expo, and a number of PIF projects that have already been announced by the Saudi Arabian government. So till date, we have committed nearly 200 crores of capex for this financial year in Saudi Arabia. And whatever equipments have been imported have moved directly from the port to the job site. So today, all our equipments in Saudi Arabia have an order, and we are positive and we are confident to continue this positive momentum going forward.
Understood. So 200 crores you've invested in Saudi Arabia. Any further investment that's been lined up for Saudi Arabia? Number one. Number two, what is the capex outline for India? For 26 and for FY27, and both of these capex, Saudi Arabia and Indian capex, how these are being funded?
So subject to the board approval, we have somewhere around 400 to 500 crores of capex lined up for this financial year FY25-26. Our funding is a mix of internal accruals and long-term debt borrowings from our banks, and we have not yet firmed up the capex for the next financial year, which is FY27.
Understood. Rishi, if I were to talk about your borrowings, so borrowings as of FY25 stand at around 376 crore. Any target that you have set when it comes to debt to equity ratio for for next 2 years?
So our debt to equity has been very healthy at 0.35. We are a capital intensive business that requires us to consistently invest in our fleet. And going forward, given the opportunities not only in Saudi Arabia but also in India, we do look forward to doing a sizable capex subject to our board's approval. We are also sitting on surplus cash, which will bring down our net debt to equity, and therefore we believe that we have a very healthy balance sheet which will support our growth aspirations.
Understood. Also, Rishi, if you could, talk about the contribution of Saudi Arabia to add up in your top line, for in next 3 years. So, any target that you have set, any ballpark number, if you could, give us.
So our order book, which has been disclosed today, which is 1,000 crores plus, does not reflect any of the business in Saudi Arabia as of today, as we are still in the startup stage and we are in the very early days. Going forward, we will give a guidance in the coming financial years for what kind of revenue contribution we can expect from Saudi when that business reaches its maturity.
Understood. And sticking to Saudi Arabia business only, what kind of competition are you seeing when it comes to this market, and what kind of market share are you looking to capture, for I would say in a medium term?
So the Saudi Arabian market is not a nascent market and it's not a mature market. I would say it's a developing market given all the infrastructure activity that has been announced in the kingdom. There is a severe shortage of cranes to meet all the demand that has been generated from all these mega construction projects. So we believe that there is a sizable opportunity and that the demand for cranes far outweighs the supply of cranes. Going forward, it is our stated ambition to become one of the top 5 crane rental players in Saudi Arabia. And we believe that our 3.5 decades of operating experience in India and being the 5th largest crane rental company in the world will allow us to accelerate our ambition of becoming a top 5 crane rental player.
Understood. Also, Rishi, there were concerns about a crane rental business wherein the industry was experiencing, a kind of high competition. Just wanted to have an update there. What's the outlook there? How are yields looking out?
So while competition still is an important factor, being the largest crane rental player, not only in India, but also Asia, we welcome this level of healthy competition. Notwithstanding the same, we are still able to maintain a 2% yield. And going forward, we believe that this yield will be held around 2%.
Understood. And Rishi, my last question to you would be, for next 5 years, I would say, because you have seen a business shift. Sanghvi Movers being purely a crane business has been shifting to Wind EPC. What's the vision for next 5 years? Where do you see Sanghvi Movers in next 5 years?
So Varsha, this is a question which is really dear to my heart. Recently, we have announced Elevate 2030, which is our 5-year roadmap and vision that talks about Sanghvi Movers retaining and strengthening its number 1 position in Asia and India. It talks about further developing our EPC company and pivoting it from an EPC company into, we have aspirations into becoming a development company as well as an IPP. And we have our core crane rental business, which is expanded globally into Saudi Arabia. So Elevate 2030 talks about a diversified business, both in product offering and services, as well as in geographies. At the same time, we will create massive shareholder value by unlocking each of these BU verticals with their own leadership team, P&L, and their own financial goals. So we are very positive and bullish for the next 5 years, and we continue to invest in our core crane rental business while simultaneously growing these new business verticals.
So that was the management of Sanghvi Movers. Lots to watch out for from here on. That's all that we have on this session. Thanks for watching KYC. Lots more lined up on the other side. Please stay tuned to NDTV Profit.